looking at the 2014 results, I think the key theme in these results is really about the transformation of the portfolio. So in terms of growth in distributions, our growth came in at 5% in normalized distributions for the year, and that was very much in line with the guidance we had given the market. But really the true story of Vukile in this year is how we've been able to transform the portfolio, really growing the asset base by over 34%, and at the same time delivering a very strong operational performance. The asset growth was driven by the inclusion of the East Rand Mall acquisition, the Ensure transformation portfolio, the sovereign tenant portfolio that we bought from them, as well as the shopping centres of in Hammersdale and Letlebile that came in during the course of the year. At the same time, we sold nearly 300 million rands worth of higher risk non-core assets, and that in a sense created a bit of a drag in earnings because we sold higher yielding properties and reinvested that money in better quality but lower yielding assets. For the future, that is absolutely the right thing, and we believe will do very well for the fund. But the most exciting aspect about the results this year is the operational performance in the portfolio, and I'd like to just dwell on some of the key numbers for a moment. Like-for-like growth in net property revenue was a very credible 6.8%. Vacancies are now trending in the right direction and down to 6.7% from 7.1% in the previous period. When we take out two properties that are currently being sold and which are skewing the vacancies drop to 5.3%, and even further when we take into account some progress made post-year end, vacancies in fact are now sitting slightly below 5% in terms of GLA. 91% of leases that were due for renewal have been renewed, and in terms of reversions, we achieved positive reversions across all sectors, with the retail sector being our mainstay performing particularly well with positive reversions of 7.8%. We achieved a weighted average base rental increase of 12.5%, and that comes off a similar increase in the prior year, and both those give testament to the improving quality of our portfolio through our active sales and acquisition strategy that we've been through. On the whole, Vukile is very conservatively positioned at the moment from a debt point of view. I think the rising interest rate cycle is something that one needs to be mindful of. We're sitting with an LTV net of cash at around 30%, of which 88% of our debt is hedged for an average period of 3 years. So we think we are very conservatively positioned in the market into a rising interest rate cycle, and will continue to be so in the next short while. Looking forward to the year ahead, we believe that Vukile now will be able to start delivering growth in distributions, at least in line with and hopefully ahead of the forecast sector averages of 7 to 8%. We have taken a view of interest rates rising by 200 basis points during the year ahead, and provided rates rise by no more than that, we think we should be able to deliver growth at least in line with and potentially ahead of the sector averages of 7 to 8%.
That's great.
Okay.
See, I could never achieve